budget and do good things. So, did you want to give us a little background on yourself?
I graduated from York University with a business degree, majoring in accounting and finance. I then went right to shares and run, chartered professional accountants.
Went right in it.
Went right in.
Nice.
Got my CPA in 2021. And now I'm a manager. I've been there for 6.5 years.
Great. Awesome. Well, and I can say, as I said before, Matthew's my go-to.
Yeah.
Need help? I don't know. I have a situation. What do I do? Someone had a weird question. So Matthew is my go-to at Shigeris for the office. So they're very well versed in real estate, agents, of all that kind of accounting, bookkeeping, stuff like that. So I can definitely attest to that. So, and thank you, Matthew, for all the help that you've given me, because we always have good stuff. So thank you.
Yeah, we do the accounting for, I think, 8 to 10 now, fellow offices, and a bunch of real estate agents and practice. So, yes, we're very well versed. We have a big team at that time. The advantage of going to a bigger firm is you can bounce questions off other managers, other partners. It's really around it here. So, I wanted to base the majority of this off of Trexler sole partnerships, because it is a relatively new thing. And then also talk about some differences for corporate tax and personal tax, as well as some investments, how to use those strategies to save or defer tax, and then Q&A. So I am an accountant by nature. I'm not a public speaker. I don't think I've ever spoken for an hour straight in my life. So if you guys have questions, just raise your hand or shoot them out at me. I'm going to try not to get too technical with this. But if it's anything I know or want further clarification, just I'm happy to turn this whole thing to a Q&A if that's where it goes. So, where's there? How many people have practice? One. How many people are starting to think about whether or not they're going to start a practice? 2. So the general idea is, don't have a practice. All your real estate commissions are going to get reported on your personal tax return each year. If you do have a practice, it gets reported as a corporation, and then you pay yourself out a dividend or salary, which gets reported on your personal tax return. So whenever anyone is thinking about doing it, the question they're going to have is it going to save you money? Is it going to save you tax dollars? At the end of the day, are the additional costs to set up the practice and the additional costs to do a corporate tax return each year and to do a set of financial statements each year worth the benefit? So there's 2 pros for corporations, any corporation. There's the limited liability aspect, which is if my prep gets sued, whoever sued me can't come after me for any personal assets. They can't come after my house, my car. The prep is its own entity. That's the entity that's getting sued. And then obviously tax advantage strategies of prep. There's 3 main ones. So the first one is simple tax deferral. And all of these strategies are based off the idea that corporations pay less tax than individuals. If you're under $500,000 in a corporation, you have a set tax rate of 12.2% on any actual business income, whereas personals is based on the marginal tax brackets. If you make more money personally, you're at a higher tax bracket, you're going to pay more. So the 3 strategies are 1, tax deferral, and that's where I'm going to decide to keep all my money in the prep. I do not need to declare anything personally to myself. I'll only pay the 12.2% tax on whatever my net income is, and I will defer that tax on the personal side to some future year. Second 2 are the tax saving strategies. So the first one is income splitting. If you have a prep and you have, say, another individual, say a spouse, as a preferred shareholder, or you did salary them out, now you're splitting that net income that you earned into 2 different streams, 3 different streams, instead of reporting it all on your personal tax return alone. And the third one is income smoothing, which is based on the idea that you try to keep your income that you declare personally as even as possible each year. So what you're trying to avoid is the huge spikes in income. In this industry especially, you could earn 1 year 300,000, the next year you earn 80. You don't want to pay high rate tax on that 300,000 and low rate tax on the 80. You're trying to keep it smooth at 100 or 120 each year. And then also the idea behind that is you can have your prep into retirement. So if you earn $200,000 each year for 10 years, you have $2 million in the prep. You can take that out over a 20-year span at $100,000 a year, and you keep yourself at that medium tax rate personally. So types of income, like I said, there's salary, before dividends, two types, eligible and non-eligible. We'll get into the difference, but essentially you pay less tax personally on eligible dividends, and that's because you paid higher rate tax in the court. So there's $500,000 small business deduction in the court, which you'll pay 12.2% tax on. Anything above that, you'll pay 26.5%. So if you pay the 26.5% tax, that income you can then declare as an eligible dividend. You'll pay less tax personally because you paid more tax in the court. Then obviously with a corporation, you're going to have a set of financial statements each year. Balance sheet is your assets, liabilities, equity. Income statement is your revenues, expenses, and net income. So the balance sheet is continual. The end of year balance will be the start of year balance as it keeps going. The income statement resets to zero every year. So it'll be your net income for that year. The start of the next year, it goes to zero. That net income gets rolled into what's called retained earnings. So two things that you need to keep an eye on when you have a corporation are retained earnings and your shareholder loan. So, like I said, net income gets rolled into retained earnings each year, which is essentially an accumulation of all your net income earned throughout the life of the practice, less any dividends that you declare from the practice. So it's a running total of essentially the money that you will eventually need to pull out of the practice. So you don't want that retained earnings balance to continue to grow each year, because you will eventually need to pull it out through dividends. So that's what I was talking about with the smoothing strategy, where you want to declare dividends evenly throughout the life so that you're in a constant personal tax bracket. A shareholder loan account, think of that as all of the funds you put into the prep and took out of the prep throughout the year. You declare a dividend, it's going to credit the shareholder loan account. If you put money into the prep, it's going to credit the shareholder loan account. If you take money out of the prep, it's going to be a debit to that shareholder loan account. CRA says that you have to declare a dividend if your shareholder loan is in a debit balance for more than a year. So in that second year, if it's still a debit balance, you have to declare a dividend in order to clear that debit balance to zero. That is important for tax strategies, because what it means is if you want to take advantage of the income smoothing, you have to be disciplined in that money has to be kept in the prep. If you pull the money out, that shareholder balance goes to a debit, you have to declare it, and you have a choice for the CRA. So those are things, some general ideas before we get to the details. But the corporate structure, general corporate structure would be you, the realtor, 100% common shareholder of the personal real estate corporation, and then a holding company on the side, maybe two holding companies on the side, where if you wanted to transfer some funds and invest in those holding companies, do that. And then also, like I was talking about with the income splitting, that you could have a spouse or another individual as preferred shareholder, so that you can declare dividends to both of you and have two different streams for that income to go to on the personal side. On that side note, practice are a little different than regular corporations. A regular corporation optimal structure would be a trust at the top, which owns the corporations, and then the beneficiaries of the trust being yourself, the spouse, your kids, and the benefit of that. Well, there used to be an income splitting benefit of that where you could dividend up to the trust and then split it out to kids, but there's new choices rules that don't allow that anymore. So the real benefit of the trust now is upon eventual sale of the corporation, you have what's called a lifetime capital gains exemption, which is 1.25 million per person. So if you sell your corporation for $5-6 million, it goes to the trust. You can spread it out through each beneficiary, utilizing the full 1.25 for each person, reducing or, in most cases, eliminating tax completely. But like I said, that's not a thing for Trex. The realtor has to be 100% common shareholder, and Trex are not usually saleable just because you're a part of the Trex. If you're gone, so tax. So this is the personal income tax structure, which I'm assuming most of the people will be familiar with. Like I was saying earlier, you have higher income, you're going to be in a higher bracket, you're going to pay higher tax. So for 52,000, you're at 19.5%. Between 52 and 57, you're going to pay 23. Up to you're over 253,000, you're up to 53.53%. So this is kind of where what I was saying earlier, where you want to try to maintain whatever your desired bracket is throughout the life. You don't want to be jumping from paying 44% to paying 23% money. You want to maintain that 37 or 33% tax bracket. And then with corporate tax, it's completely different. They're set tax rates. So, like I said, 12.2% on the first 500,000. That's your small business deduction. And then if you're above 500,000, it's 26.5%. But if you go above the 26.5%, that income gets put into a GRIP pool, which allows you to declare eligible dividends. They are in the tax. In the court, you pay less personally because eligible dividends are taxed at a lower rate. Then there's passive income, which is investments, interest, dividends. Those are going to be taxed at 15.17%. And if you earn that, you're going to get what's called an RBTOH balance, which allows you to claim a dividend refund in the court when you pay yourself out a dividend. And then capital gains, there's 50% inclusion, which means that 50% of your capital gains will be your taxable capital gain, which is taxed at 51%, so it's about 25% on the capital gain. And that gets put, after that gets put into your CBA balance, which means you can declare a capital dividend yourself, which is tax-free. So all of that information, what does that mean? All of these systems are put in place by the CRA to essentially reduce the difference between people who have courts and who don't, assuming that you pull all the money out of the court each year. So, an example, what I mean by that is, say an individual earns 120,000. So tax on that would be 29,890, which means your after-tax dollars is 9110. Corporation, you pay 12.2% on that, which is 14,640. After-tax dollars in the court is 105,360. But like I said, you need to pull that money out and pay tax personally on that still. So you declare then a dividend on the after-tax 105,360, which results in $68,050 in tax personally. Your after-tax dollars $89,310, slightly worse than what you would do if you didn't have that. So that being said, if you're going to pull all your money out of the track and use it each year, there's no benefit to starting the corporation. And that's really depends on life choices and financial discipline, right? There's nothing wrong with wanting to spend what you make, but if that's what you're going to do, the corporation might not be the best option. that example two here, this is where what I was talking about earlier with the income smoothing. So say you make 80,000 in year one and 20,000 in year two. Instead of declaring the 200,000 in year two and 80,000 in year one, paying high rate tax, 200 and lower rate tax in 80, you're going to pay yourself $100,000 each year and keep the rest of the money in the court. So in year one, 80K, that's 16,100 tax personally. Year two, 200K, 66,300 tax personally. Both years combined, you're looking at after-tax dollars of 197,600, which is the 280K less the 82,400. So in a corporation, you're going to pay 12.2% on the 80K, that's 10,760, 12.2% on the 200K, 24,400. Tax for both years is only 34,160, after-tax dollars, 245,840. And then you pull out 100,000 each year, which is equivalent to 14,500 tax personally, tax 2 years, 28,230. Your after-tax dollars are 270,610 compared to the 197. So it's a significant benefit if used properly and if you have the discipline to maintain the course. And then any funds, of course, that are after tax, you can then invest it within the court or outside the court. But you just need to make sure that in order for this to work, you can't pull the money out of it. You have to make sure it stays in there and you invest it within the court. Once you pull it out, that's when your shareholder account's going to start going into a debit position and you're going to be forced into declaring dividends.
So for a first time home buyer, it probably like if you have just a home that you're pulling a lot of your funds for purchasing home, probably be smarter to do it after you purchase it.
So we'll get into the investment stuff later, but first time home buyer, there's the benefit for that is that you get a deduction on your personal tax for money invested in that home buyer account. So you can pull more out of the court, you're going to increase your taxable income. But then whatever you then put into your first time home buyer, you're going to reduce your income personally by that. So it's essentially a wash. That makes sense. Any other questions? All right. So yeah, like I said, I briefly discussed this already, but tax advantage in court, deferral, leaving the dollars in the court, and only paying the 12.2% rate. Not the best strategy long term, because like I said, you're going to eventually need to pull that money out of the court. And then tax saving strategies, income splitting and income smoothing, which I already just spoke about. HST, everyone's favorite. So, best way to think of HST is it's essentially a holding account. You make 115,000. You didn't actually make 115,000. You made $100,000. They just gave you $115,000 of cash for it. And that additional, well, 13,000, 50%. That additional $13,000 is what you owe to the government for HST. Everyone at the end of the year always says, I thought I only have to pay 12.2% tax. Why am I paying this much in HST and this much in corporate tax? HST isn't a corporate tax. It's essentially money that was given to you that you're holding for the government. Now, once, so,
No, sir, it's not your money.
yeah,
Don't use it, don't spend it.
exactly. And so many people
Yeah.
get this cash, spend it,
Yeah.
and then at the end of the year, like, how do I owe 26,000? I don't have any money to pay this. So that's where financial discipline and understanding your current financial situation is so important, especially when you're an annual HST filer, which 95% of people will be if you have, if you're under 1.5 million of revenues, there's no reason to be 4 million monthly. So 95% of the people choose to be annually, and you can build up $50,000 in HST payable at the end of the year, and you have to make sure that you have those funds to pay it at the end. So HST, there's two methods, standard method and the push method. The standard method is the regular 13%, where you collect 13% on your revenues, that's payable to the government, and any expenses that are HST applicable, you get 13% as income tax credits, which reduce your HST payable. So your HST payable at the end of the year will be whatever you collected minus 13% of whatever expenses you have that are HST credit. And the quick method, on the other hand, is beneficial if you have relatively low amount of expenses, because you still collect 13% like you do with the standard method, but instead of remitting 13% to the government, you only have to remit 8.8%. But you don't get to claim any income tax credits to reduce that balance payable. So you're paying 8.8% of your revenues. So if you don't have a lot of expenses, 8.8% instead of 13, it's beneficial for you. If you have enough expenses to reduce that HST payable at 13%, then it's not beneficial.
Is there a ballpark at the top of what that figure?
Like the number of expenses?
Range of income.
It's not income, it's all about expenses. So 90% of the practice we do, real estate agents we do, it's not beneficial. You'd have to have a very significantly low number of expenses.
At that point, then does the cost of the practice not override any benefit that you save from 8.8 up to 2%?
What do you mean by that?
Well, those have ongoing costs to administer the practice.
But you can earn revenue still of large amounts, right? So it's not that you're not earning income, it's that you don't have expenses to offset your revenues. So you can still earn $500,000 of revenue. Practice, it's unusual. Real estate in general is unusual because you're going to have a decent amount of expenses throughout the year. But there's certain industries, on the sort of YouTubers or something, they can earn mass amounts of revenues and have very little expenses to offset that. So that's when the quick method would start to outweigh the standard method, but for most cases, the standard method is the better option. Okay, so some differences for accounting and tax. So very rarely will you, at the end of the year, have the same taxable income as your net income. And it's important to understand these differences when you're calculating how much tax you think you're going to owe at the end of the year. Because some of them can result in some significant changes. So some common items that are deductible for tax: penalties and fines, law fees, life insurance, and 50% entertainment. So what that means is your net income is going to include these expenses, but your taxable income will not. So your taxable income will be higher than your net income. Amortization versus capital costs, CCA. So amortization is probably something that you guys all have heard of. You have a capital asset, it gets amortized over a certain number of years. So you don't claim that expense all at once. And I've seen it before too, where people are like, how do I owe tax? I have $0. It's because you bought a $60,000 car during the year. That shouldn't have been an expense. That should have been put as an asset, which gets depreciated over a certain number of years. So amortization is for financial statement purposes, and you can really choose whatever you want for that number because it doesn't matter for tax. And the CRA doesn't care because they say, we're adding that back to your income. We're deducting CCA, which is amortization with more strict rules. So depending on what asset class you have to amortize it over a certain percentage each year based on the CCA classes and CCA rates for those classes. Then there's what's called internal loss and recapture. And this sort of ties into capital gains. So it's probably easiest to explain with an example. So say you have a vehicles, what?
The jet ski.
Yeah, jet ski. So you bought the jet ski for whatever, $10,000. You depreciated by $3,000 over its lifespan. So its book value is now 9. You then sell it for $9,500. So for accounting purposes, that's going to be a $500 gain, which you would think is taxable at 50% because it's a capital gain. For tax purposes, there's no law, you can't report that gain as a capital gain. Instead, you're going to have CCA recapture. So you claim $3,000 of CCA, you sold it for $500 more. You're going to have CCA recapture of $500, which is an income inclusion. This example is relatively small, whatever, it's not a big deal. But if you say have a property in the tract, or in another holding company, any corporation, really, if you're amortizing that property over 20 years, you could bring its value from $1 million down to 500,000, say. You're then going to sell that property for 1.5 million, assuming the market goes up. You're going to have a capital gain on what was the original ACV of 1 million. The difference between that and the 1.5 million, so $500,000 capital gain. Then, because you took CCA of 500,000 throughout its life, you have an additional 500,000 income inclusion for tax purposes. So you're paying income on the additional 500,000, income on the capital gains. You really get the card whenever you sell this property. So the thing to remember with that is you can choose whether or not you want to take CCA. Generally, it makes sense for assets that appreciate because the CCA recapture shouldn't be that large. But for an asset like a property, it's a bigger decision to make because you know most likely that's going to increase value. When you sell it, you're going to get hit hard for tax. If you don't have a corporation, I generally don't recommend taking CCA on any properties unless you're already in the high tax bracket. Because then it's just a deferral, right? You're going to pay high rate tax either way. You're just deferring that tax by taking the CCA. If you're not in that high rate tax bracket, that CCA income inclusion can cause you to jump then to the highest tax bracket when you sell the property. All of a sudden, you're now paying 53% tax on the sale instead of paying the tax slowly throughout the years. And then on that same subject, there is what's called immediate expensing. That was something that was in place with corporations over the last 2 years. It ended in 2024, December 31st, 2024, and individuals, this is going to be the last year of immediate expensing. And that was put in place by the CRA. And really what it is any, well, not any asset purchases, but most asset purchases, other than property, I think, you've got to claim the expense in the first year. So that CCA that I was talking about, you claim all of that in year one when you purchase the asset. You get an income reduction, which is great, but then you have to remember, if you sell that asset in the future, you're going to have a full income inclusion of whatever that cost of the asset was. You have a vehicle that you bought for $60,000. You claim $60,000 at the expense in year one. If you sell that in 2 years, you're going to have $45,000 of income inclusion in the year you sell it. So it's really important to understand these things, especially when you own the corporation, because it's very easy to get blindsided at the end of the year if you don't have a really good grasp on what your bookkeeping situation is and these accounting topics and the difference between tax and net income. And then just one other thing for this topic, vehicle expenses. So if you have a corporation, there's 2 options. You can either own the corporation or own the vehicle in the corporation or own it personally. If you own it personally, it's simple. You use the CRA vehicle mileage rates, which I believe are 74 cents on the first 5,000 kilometers and then 64 cents for the remainder. So you calculate how many business kilometers you drove during the year. You take that, multiply it by the rates, that's your vehicle expense for the year. If the vehicle is owned by the corporation, you should be reporting your expenses based on what you actually incurred. I paid this much in gas, this much in maintenance, this much in whatever it may be. And that's your expense in the quarter. Then you will have to do a T4 auto bend for whatever your personal benefit of that vehicle was. So if you drove it 30% for personal use, the rest for business, you have to T4 yourself, which is essentially income on your personal return for that benefit of using a corporate asset. So that being said, that can drastically change people's vehicle expenses at the end of the year if you're tracking it on bookkeeping based on all your gas incurred, all your repair and maintenance. You have 12, 13,000 vehicles that's built up during the year, all of a sudden that goes down to 5 because of the CRA rates. That changes your taxes. So again, understanding the differences between how things are reported, how they should be reported, and how they're reported for tax makes a huge difference for understanding your total financial position. Okay, any questions on any of that before I move on? All right. So investment tax strategy. So this is where the FHSA is going to come in. But the FHSA is fairly new. The two main ones are RSPs and TFSAs. So the main thing to remember with RSPs, you're going to get a tax deduction in the year you contribute to your RSP. So to reduce taxes in that year, when you pull the money out of the RSP, that's going to be an income conclusion for tax. It's going to increase your taxes in that year. Both of the TFSA and RSPs are tax deferred growth. The benefit with the TFSA is that there's no income conclusion when you take it out, but you don't get the deduction when you put it in. So it's tax free all the way through. So how does that factor into your tax strategies? The general idea is that you want to invest in the RSPs in years when your income is the highest to get that income deduction, and then pull money out of your RSPs in years when you have less income, so retirement, so that you're reporting that income in years that it's low. And it should be a long-term strategy. You invest now, you're not going to take it out until you retire and your income. If you want more liquid cash, you want to be, I'm going to buy a house, maybe I'm going to buy something, I want to be able to take it out in a year or two. TFSA, max out your TFSA first before putting anything in your RSP. And then FHSA, we briefly talked about it, it's kind of a merger of the two where you get the benefits of both. You get the tax deduction in the year to put the money in. And when you take it out, assuming you take it out to buy a house, you don't have that inclusion that the RSP. And then RESPs are another good strategy if you have kids. Again, there's no tax deductions on contributions, no tax deductions on withdrawals. There is some growth within the RESPs that will be taxed, but the good thing about that is that it gets taxed in the hands of the child, who generally doesn't have any income because they're in school. So they're paying minimal, if any, tax on that. Okay, so yeah, kind of just to tie it all together. So the importance of bookkeeping and understanding your financial position. Everything that I've spoken about, really, in order to utilize all of these strategies, you have to have a very good understanding of your bookkeeping. It has to be up to date. You have to know what your financial position is at any point throughout the year. And you have to have a good grasp of what your future plans are, right? You can't utilize these strategies for income smoothing and RSPs, or do RSPs or TSAs without knowing what your plans are 5-10 years down the road, and without knowing what your current tax situation is. That's number one for people, because number two, knowing how much your tax is going to be at the end of the year and installments. Like you said, people come at the end of the year and go, how do I owe $26,000 in tax? I spent all my money. I don't have anything to pay for this. So really knowing that halfway through the year, making installments, putting aside money to pay for the taxes is super important. And then, like I said, it allows you to make investment decisions to take advantage of the tax strategy. So all of those things, we have so many clients, you're preparing your tax return at the end of the year for 2024, say you're not doing your tax returns until March, April. It's already too late at that point to say, oh, I want to put some in my RSPs because I don't want to even see if I just figured it out in March of 2025. That has to be something that you figure out throughout the year. Oh, I'm having a good year this year. I'm probably going to have a lot of income. I need to invest some in RSPs. And the only way to do that is by having up-to-date bookkeeping, knowing your position, and having meetings with professionals needing to figure out what the best strategy is for me, so I don't pay a crazy amount of tax at the end of the year. And then the last one, accurate data for CRA reviews. CRA is reviewed for providers, and they will ask for a detailed ledger, so your general ledger of all transactions that happen for whatever they were doing on. Say they were reviewing for your meals and entertainment expenses. They're going to want to know every single meal and entertainment expense you had, and then receipts for the top 10 items usually. So what's that? You have to keep detailed records so that final number, because they're all they see on their end is you spent $5,000 on meals and entertainment. You need to keep a detailed ledger of every expense so that adds up to $5,000 at the end of the year, matches what their number is, and keep receipts for all those things. Because they won't accept a bank statement, they won't accept a credit card statement. They only accept hard copy receipts.
When you say hard copy, like I keep everything in QuickBooks.
As in like a picture on QuickBooks, then that's not it. Because you're not hand delivering it to them. Still has to go. Yeah, so it has to go online.
Like the actual.
Yeah, but it is the actual receipt. You just need to take a picture and upload it to your QuickBooks.
For example, like what if your QuickBooks is linked to your card and stuff like that? So when you pay something, it goes in from.
Yeah,
Is that okay or not?
no, it doesn't matter. Because that's the same thing as giving them your credit card statement will say this. Same warning, like, why would they care? But they wouldn't get that. And a bit off topic, but sort of topical, with the increase in Airbnb popularity. Some of you may have rental incomes, some of you may just be renting a portion of your principal residence. There's two types of rental income: short-term, long-term. Short-term is anything under 30 days, long-term anything over. If you're doing long-term rent, you're fine. There's no implications for HST. If you have short-term rent, that is an HST-able revenue. If you go over 30,000, you're required to register for an HST account. If you already have an HST account and you're earning short-term rent, you're required to remit HST on that rent. Now, with rental income, the big thing to remember is what is the main use of the property. And CRA doesn't give concrete definitions on what primary use of the property is. For argument's sake, we usually say 50%. So if that property, let's stick with HST for now. If you're earning short-term rent on that property and you're renting out more than 50% of that property, more than 50% of the time, you can then expose yourself to risk that that property is now changing use to a HSTable property, which means when you sell it, you have to remit 13% of the sale price. You're gonna lose 13% off the top. So, big things to remember for that are availability for rent and the portion that's being rented. If you're renting your basement of your principal residence as an Airbnb, it's less than 50% of your home, you're probably fine. If you're renting the whole property as Airbnb, that's when you're exposing yourself to some risk. And availability for rent would be how long is it on the Airbnb site. So just because you rented it only for a month out of the year, that doesn't matter if it was on Airbnb the whole time, because it was available for rent, quote unquote. You were trying to rent it. And then principal residence implications, that relates to what I said about if you're renting a portion of your principal residence, again, primary use of the property. If you're renting your basement, probably fine. But if you're living in your basement and renting the whole top 2 floors, now the primary use is a rental unit, it could affect your principal residence exemption on that property. So, yeah, a lot of things to consider if you do have a rental property or if you're renting your principal residence. That's it for me. So, questions on any of that? Yeah.
You might not be like, as a real estate agent, is it best to lease a car, finance, or buy it outright for tax purposes?
So for tax purposes, do you own a court or are you?
No,
So it's all T1?
same boat as like Brooke, because I haven't bought a house yet. Obviously, it would be good to. get
Yeah,
a-
yeah.
buy a house.
Generally, it doesn't matter. It's because you're going to claim the amortization on the vehicle anyways, or you're gonna claim the lease expenses. So
Is there one that adds up more than the other?
it depends on what your lease agreement is. Depends on the cost of the vehicle and what your lease agreement is. So you can work it out very easily. It's 30% CCA rate for vehicles. So whatever the cost of the vehicle is, multiply that by 30%, that's your CCA for the year. Then your balance at the end of the year will be the cost less whatever CCA you took. So the CCA will keep reducing year over year. Lease costs will stay more controlled. They'll stay the same every year. So you just have to calculate what your total lease cost would be versus what your CCA would be. And then if you want to pay more of an expense in that year, go with the lease.
They only cover up to, I think they upped it to like 38,000 right now.
For passenger vehicles,
Yeah.
there's rules on passenger vehicles for leasing expenses too. So there's a
You can only
maximum,
cover up
there's a
to-
maximum monthly lease amount that you can deduct for passenger vehicles. So they're made so that it's equivalent.
Your slide had TFSA tax deferred. You explained how the deferral worked on that, because to me, it's tax free, right? Like any money that you're inside.
Did it say that? It should know it's a
It
tax
said yes and yes, so I see yes.
Tax deferred growth.
Tax deferred growth.
So when we put the money in the TFSA, as it's growing in there, there's no tax on it.
Correct.
So a regular investment account, once you invest in it at $100,000, if you earn dividends or interest in a regular investment account, you're paying tax on it. With a TFSA, that's all tax free.
How long are you eligible to make investments into TFSA, and how much are you?
It keeps growing year over year. So you have a limit for TFSA off the top of my head, but each year it's 7,000.
I think so, that's
Yeah.
102 total, it's since inception, if you haven't invested anything since inception.
Yeah.
I think
So
it's
the-
102 or 109 now.
Yeah, it'll just keep growing year over year. So if you haven't invested in your TFSA,
Over a
At
year.
90.
You were- I think
At
you might
90,
be-
still.
yeah.
You were 109. So you can-
Yeah.
That's gotta be our best tool. I mean, that is amazing.
TFSA, oh, yeah, great. Especially if you want your money, like, you don't know when you're gonna use it, you want it to be available whenever, it's.
I agree.
Yeah.
The RSP is not bad either, and again, I'm seasoned, the seasoned people, except for you, are on this side of the.
Yeah.
Seasoned people are on
Yeah.
the side. But I was going forward, I'm gonna start converting RSPs to risk.
Yeah.
And I'm gonna go past the 65 and take the 8.4% a year on the CPC
Yeah.
for a bit.
Yeah.
I don't know how long I'm on planet,
I'm
so.
gonna talk to you.
So if I'm on the planet first, if I'm on the planet for a while, I'll do it 1 year at a time and I'll.
Yeah.
I'm on the planet.
Like that's the thing with RSPs, it's a great tool on paper, but generally people's income levels are similar at retirement as they are when they're not, right? Like you're gonna be making money, if you make a lot of money during your working years, you're probably gonna invest a lot, you're gonna have a lot of investment income. You're gonna have your RSP income, you're gonna have your CPP, and the rates generally don't change that much, so it's not like you're gonna get a huge benefit from the tax deferral and contributions for withdrawals, but you do get that tax rate growth. You can't beat that.
Yeah. With regards to like getting a prep, et cetera, let's say you have a house now. Is there a certain income you should be making to open up a prep? How much does it cost? Who do you go through?
Yeah, you can start it up yourself. We have our company, Think Green Law, well, it's not ours, but for connected corporations. I believe they charge $750 to start it. They create documents, yeah. With regard to how much income, the main thing it comes down to is how much money do you need to live versus how much money are you making. Because if you can take advantage of the income smoothing technique, even if you're only making 80,000 in the prep, if you only need 50,000 to live, you're still getting that slight benefit. I would say generally, to start a prep, you have to be making over, or you should be making over 100,000.
Or at least, yeah.
Like anything under that, you're already at a pretty low personal tax rate, so the benefit's not huge. But you never know when you're gonna have that year, especially in this market, in this industry. You never know when you're gonna have that year, and it's just COVID times. Houses were going crazy. I'm getting 300,000 all of a sudden, and at that point, it's too late to start because you already earned that 8%.
You started before the closing happened?
Yes. Like, so,
Start the prep before the house closing.
yeah.
Yeah, I don't know how long it would take for the forms to go through, how instant it is,
But it could
but
be 60, 90-day closing.
yeah,
You know, you
Yeah,
get
yeah.
a big one, then you start the prep, say, 10 days into it, and yeah, it can be done.
yeah. And you'll know if a big year coming 2 to 3 months into
And you
the
beg
year. Yeah,
Daniel to push through paper.
Yeah.
Daniel's a green law.
yeah, that's great.
How much does it cost to run one, like, to get your taxes done, filed? For
Each
like,
year?
yeah.
We charge, our standard fee is $3,500 for the compilation engagement, which is your financial statements and corporate tax return. And that will be in addition to your personal taxes.
And the threat has to be, can this done always living there, right? If I have a
No.
defined benefit, I can't.
No.
It's strictly real estate.
It's real estate or it's income,
Derived from.
yeah, self-employment income you can have if you have some selling something else on the side. Yeah. Yeah, you can't put like your Jeep or
So sad.
Yeah. Really good tax control. Does your firm handle any US, Canadian mixed marriages where there's a mixed investments, if you will?
We do have lots of people with US investments. We do a few that are not citizens. And then any US component to that, we would outsource to one of our connected
So I know when you pull it out of your private state when you're retired, but when it's in there, you pay that 12.2%. But then when you pull it out, you're also paying your personal tax on it. So is that the same? Are you
So-
essentially almost like doubling down on the
No.
tax?
That's a good question. That's a question we get all the time. So the answer is no. If you pay yourself a salary in T4, that is paid out of pre-tax corporate funds. So to make the example really simple, if your corp makes $100,000 in net income, you pay yourself $100,000 T4, that's $0 of corporate. So you don't pay tax on anything, you only pay personal. Dividends, on the other hand, are paid out of after-tax dollars, so that's what the retained earnings comes in. So you pay 12.2% in the torque. Now, whatever net income is left over, that goes into your retained earnings, which you can declare dividends from. And here you see dividends are always less than the regular income rate. So that's the factor in, because I already paid 12.2%, I pay less tax person on those dividends. If they're eligible, they're even lower because you pay high rate tax report, 26.5%. The more tax you pay in the board, the less tax you pay personally.
And that's forever, like even when you're 8 years old.
Yeah, the same rules apply. And those rules are all put in place essentially to reduce the difference between owning a court and not owning a court, assuming you hold, don't take advantage of those strategies that I mentioned. Simple. I told you, everyone has a question.
Anything else? Anything else?
So free tax advice.
Yeah.
Yeah.
Well, thank you for
Thank you.
having me. Yeah.
We appreciate your help and support and guidance through our tax.
Yeah, I hope it wasn't too technical.
Well, do you have any cards or anything? So if
Yeah, I
anybody wants
just-
to reach
what,
out
did I
to
just,
Matt directly or Shagiris,
I'll just-
generally for some help or support, we've got some cards here and some
Okay.
apps.
Thank you.
Thank you so much for taking the trek.
Yeah, thank you for having me.
Does anybody want a card?
Thank you. Thank you.
Thanks.
Thank you very much. You're welcome.
Thank you.